Hello, TAs. Just coming to you to discuss Berkshire Partners bidding for Carter's on the leverage buyout. And I think you guys did this with Dick. So let me just sort of run you through a couple things here. I've got a spreadsheet where I built an LBO model. So just FYI, I kind of built this for students, so I think this will be in pretty good shape. Part of what I was trying to do was to get a good discussion about internal rate of return, some of the drivers, etc. So my guess is you'll find the rate here is between 25 and 32%, something like that on the IRR. Maybe just check and make sure that the EBITDA, enterprise value to EBITDA, IRR data table is about right. I did it based on gross margin. What we should be seeing is lower enterprise value to EBITDA multiples and lower gross margins drive down the IRR. And conversely, higher enterprise value to EBITDA multiple, and these are exit multiples, and higher gross margins drive a higher IRR. So just as an FYI. I also sort of, again, there's not really necessarily right answer. One thing you may find is students might have used 11.8. I bumped it up to 12.3. So our numbers might be a little bit different. That's not really their issue. That's more my issue. But it will drive up a little higher IRR, which is fine. So just to kind of talk a little bit about it, I also altered my questions a little bit, so let me just go to that quickly. Sorry, I'm a little unorganized here. So the first three: how does Berkshire Partners create value? How does Carter's fit with the Berkshire investment philosophy? Why is InvestCorp selling? Also, how realistic is management's forecast in light of Carter's historical? So I'll kind of walk you through those quickly. This first bit should be in my notes, so this is a little bit about Berkshire Partners, lists out some competitive advantages, sort of before and after the deal. They kind of tend to focus on a small number of companies, but then the question is, does that mean that they're sort of, because they focus on a small set, does that mean they're going to do those, etc.? So I would just say, how do they create value? I mean, I would say, they try to bring this kind of stuff to the deal. Again, they don't have to list everything out, but at least if they have a few, from each category, it'd be nice. But they kind of try to, identify good deals, structure the capital right, create good management incentives, and then after the deal, they help them operationally, things like that. So something along those lines would be good. And I think they should be able to get a lot of that from the case. How does Carter's fit the Berkshire investment philosophy? So probably strong growth-oriented company in conjunction with the strong equity incentive management. A couple things to keep in mind. I mean, I think their monitoring and improvements will be as it typically is. The one thing here on the structuring is that the staple financing that Goldman's offering might hurt their ability to sort of generate some of the value that they typically like to generate. So there's almost like this deal, if you kind of skip ahead, I'm just trying to think where it's at. I don't think it's really here. If I skip ahead to this note right here, Goldman's offering staple on financing. And the one thing, this may not necessarily be a great thing for Berkshire as I relate to here, because they might be able to go out and get their own financing. And, although Goldman says you're free to do that if you want, Goldman's running the auction, so they might favor somebody who's got more, who wants their financing as well in the bidding process. And if Berkshire feels that that's an advantage for them, maybe they feel like that'd be taken away. Now, overall, I think the staple on financing would promote some bidders that wouldn't bid otherwise because they already have the capital structure in place. That might be kind of nice. So at any rate, it's probably a double-edged sword. It's some good, some bad. If I go back to the notes here, sorry. Why is InvestCorp selling? Well, there's a number of different reasons. We could speculate maybe they're selling at the top. Hard to say. Why not IPO? Well, they could IPO, but that might take a while to get it out. We'll actually see when Carter's does the IPO how long it took to get their money out. At this point, it might be that InvestCorp wants to just lock in a successful investment. They kind of have to invest. They have their investors' money that they put into deals, and then ultimately they put their own money into deals and they ultimately place that with investors. Well, if they can create a win, that's good for their investors. It also gives them a good track record. There is sort of a school of thought that sometimes venture capital and private equity exit too early, which very well might be true. But, then again, they're like maybe thinking, hey, if we've got a win, let's book it so we can kind of sell that to our investors. They want to sell at a fair price. So as far as that kind of counter to are they just trying to unload at the peak? One way to think about that is, they might do that, but they might want to actually it wouldn't be the worst thing to see Berkshire do well with this deal, because eventually Investcorp may have to go back and deal with another firm like Berkshire that they could kind of say, hey, we did a good deal with Berkshire. They did well. And then it creates a future buyer in Berkshire or others that you can sort of say, hey, see, we've done deals with other companies and they've done well. So you don't want to burn any bridges. Let's just put it that way. How realistic are management's forecasts in light of Carter's historical performance? If I go look at the spreadsheet that I'm sending you guys, I've got the management forecast, and you'll notice in green I've sort of done the sort of 2000 numbers. And if you put them in light of that, they do look like they're a little bit on the optimistic side. So I kind of encourage people, and what I used in the LBO model were more like the 2000 numbers to base that. That's what I based a lot of this on. What I would say, and what we may want to, I kind of said this in the review of the case, there are two trends that are worth noting here. They are switching from domestic sourcing to outsourcing production abroad. They're also selling more with general merchandisers like Target. Those two things could drive, in the second case, sales, and the first case could drive margins. So to the extent that we see in the management forecast, for example, that margins are up significantly from what they've been historically, maybe that's part of it. They also have sales going up significantly too, which I think I don't necessarily, I'm falling a little short of that. But so it'll be interesting to see what happens. But there definitely is a difference there. If I go back to okay, now 5 is pretty much the model. So what I had them do in 5 is I had them sort of run through some scenarios. First of all, they should have something. I told them, let's do this based on the average comparable, and I think I showed you here that they can get the average EBITDA to enterprise value comparable, put that into the entry and exit, and then that becomes a basis for sort of saying how the IRR gets calculated. They also have sort of the debt, and then they have the rates over here to sort of drive the interest and the value. So I asked them essentially in this to do, assume that they decide to do the average enterprise value to EBITDA multiple. What would they get for, an IRR, the first thing? And then what would be the required equity investment? So I would say, with IRR, it's going to be something around, 25 to 32%, depending on what they assumed. The equity value they put in would be about 150 or so. Could be all the way down to 130, depending on what they change this to. That might change this number and then change the calculation. So let's not get too worried about that, but just see that it makes sense. I did all the interest calculation, and the pay down as well on the revolver. So this really was sort of building a model so they could kind of keep the big picture in mind and not spend 3 hours like in the weeds trying to figure out the model and stuff like that. So that's kind of was my thought. At any rate, so they look at that. Then I also asked them, I'll tell you what, I will finish this up on the other side.